Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. I hope I'm clearly audible and the screen is visible. So today we are going to discuss a very important RBI notification that is regarding the unique transaction identifier. Okay, so we will discuss that why the RBI has mandated this unique transaction identifier for the OTC derivatives. What are these OTC derivatives? What is the code that is going to be for the unique transaction identifier? So all of this we are going to discuss in today's session, and let me tell you that direct question from this can come in the phase 1 of the examination, in the phase 2 of the RBI Grade B examination. Okay, so we will discuss in detail about the unique transaction identifier, its requirement, its important data that you have to remember from the examination point of view. Okay, so hello everyone, good morning and welcome to the session. So let's get started. This is a very important RBI notification that we are going to discuss in today's session. So now before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session. Okay, so the link for the Telegram channel is provided in the description box below, and you will get the PDF of the session in the Telegram channel. Okay, so now we are starting with the session and we are going to start with the unique transaction identifier. See, unique transaction identifier UTI, this has been brought for the OTC derivative transactions. So the Reserve Bank of India has now decided to mandate the unique transaction identifier for all the specific derivative transactions carried out at the OTC market level. So basically a unique transaction identifier has been mandated. Like Aadhaar card, we all, like the Indian citizens, we have the Aadhaar card. Okay, so Aadhaar card number, the Aadhaar card number, it is the identification for the Indian citizens, that okay, this is the identity card, like, or this is the identity number that we have, this is the identification number that we have. Similarly, UTI will be the identification number, will be the identifier for the transactions that are happening over the counter. Because over the counter transactions, you can understand that these are the transactions that are not happening through the exchanges. These are the transactions that are not happening through the National Stock Exchange or through the Bombay Stock Exchange and such. Okay, so over the counter transactions, these are the transactions that do not happen through the exchanges. They do not happen through the NSE or BSE. So for these over the counter transactions, to identify the transactions, to record the transactions properly, to track the transactions properly, and to maintain the transparency, there is the unique transaction identifier that has been mandated by the Reserve Bank of India for the derivative transactions, particularly for the derivative transactions that happen through the over the counter market. Okay, we will discuss it in more detail, but I hope the basic idea is clear, that like we all have the Aadhaar card numbers, we have the identification number. Similarly, now for the derivative transactions, for over the counter derivative transactions, there is the unique transaction identifier that has been brought, and it is mandated that each derivative transaction should have the unique transaction identifier if the transaction is happening over the counter, that is not through the exchanges. This is the basic idea. So at present, see, now, before understanding that why this mandate has been brought, first let's understand that what happens at present. So at present, all the transactions, first of all, derivative transactions, I hope you have heard about the futures, options, swaps. So if you are giving the RBI Grade B examination, if you are going to give the RBI Grade B examination, then derivative is a very important topic, because in 2024, from the derivatives, from the futures options, from this particular chapter, a descriptive question had come in phase 2. So this is an important chapter that you have to focus on. But let me give you a brief idea of the derivative. So derivatives, they are the financial contracts. They are the financial contracts, okay, that are traded in the financial market, we can say. So derivatives are the financial contracts whose value, now the value of the contract depends upon the underlying asset. The value of the contract depends upon the underlying asset. Okay, now the underlying asset can be shares. So this value of the financial contract can depend upon the shares. It can depend upon some commodity like the gold, or it can depend upon some like index like the Nifty 50 or BSE 500 and such. Okay, or the derivative financial contracts value can depend upon the currency or the interest rate also. So this is the idea that the derivative, it is a type of financial contract whose value the value of the derivative, the value of the financial contract, it depends upon some underlying asset. It depends upon some underlying asset. That can be shares, or that can be any commodity, or that can be the index like the Nifty 50 or BSE 500, or any currency, or the interest rate and such. So this is the derivative, that is a financial contract whose value depends upon the underlying asset. Now there are different kinds of derivatives like the futures, forwards, options, and the swap. Okay, so these are the different kind of derivatives that are there: futures, forwards, options, and swaps. Now see, futures are the derivative contracts. So futures are the derivative contracts that are traded. They are the financial contracts, they are the derivatives that are traded through the stock exchanges. They are traded through the stock exchanges. And the future contracts, they are standardized in nature. They are standardized in nature. So let's take an example, then you will be able to understand the whole article better if you understand this. Okay, so in the stock exchanges, the futures are being traded. Let's say that you are the importer and you want to import a machine. You want to import a machine that is worth 1 lakh rupees. Now you are afraid, you do not have the money right now, so you want to import this machine in a future timeline. Okay, you want to import this machine in a future timeline, let's say on 21st of March. On 21st of March. So then you will get the money and then you want to import the machine. But you are afraid that right now $1 is equal to 90 rupees. What if this $1 becomes 110 rupees? Because let's say the depreciation of rupee is happening, rupee is losing value. So you are afraid that what if the $1 becomes 110 rupees? So the machine that you want to purchase, that is of $1,000, it will be very expensive. Then right now this $1,000 means 90,000 rupees. This $1,000 means 90,000 rupees. Later on, if the $1 become 110 rupees, then you will have to give 1,10,000 rupees to get this $1,000, to get this machine worth of $1,000. So you are afraid that what if the price increases of dollars very much? So you are coming into this contract, that is a future contract. Let's say it is a standardized contract that you need to have the contract for at least $2,000. Okay, where you want to buy $2,000 and you will get this $2,000 on 30th of March. So here you can see that the future contracts, they are standardized in nature. The amount or the size is determined. The date is determined on which date this contract will expire. Okay, so usually the future contracts, they are of monthly nature that expire on the last Thursday of the month. So the future contracts, they are standardized in nature. So this importer, it is not able to have only $1,000. It needs to purchase $2,000, or it needs to come into the contract that is providing $2,000, and it will not get the money on 21st of March, it will get the money on 30th of March. So if it wants to have a customized contract, it needs to get the forward contract. Now the forward contracts, they are not traded on the stock exchanges, they are traded on the over the counter market. That is, the transaction happens over the counter. The transaction happens on the the transaction does not happen on the stock exchanges. That is the idea. I hope this is clear. First of all, why the over the counter market is required, because in the stock exchanges there are standardized contracts. The amount size is determined, the maturity date is determined. So if you are fine with the standardized contract, if you can wait, if you if you want to have the amount that the contract is providing, that is fine. But if you want a customized contract, that cannot be provided through the stock exchanges. So for the customized contract, you need to go for the over the counter market. I hope this is very much clear. Okay, so that's why the over the counter markets are required, and the forward contracts are the ones that are customized in nature. They are traded. The forward derivatives, the forwards are the kind of derivatives that are traded over the counter, and even the swaps, they are traded over the counter. Okay, so over the counter market is a market where the derivative transactions are undertaken in any manner other than on exchanges. So through the electronic trading platforms, you are undertaking the derivative transactions, or through the on the personal basis, on the private basis, you are undertaking the derivative transaction, or through the electronic trading platform. So basically, over the counter market is a market where the derivative transactions are undertaken in any manner other than on exchanges. So on the exchanges, the contracts like the futures, derivatives, they are standardized in nature. If you're fine with the standardized contract, then you can purchase it on the exchange. Now, if the transaction is happening on the exchanges, that means they are more trustworthy. The exchange will happen. You will get the money that you want, okay, or you will get the shares that you want. Over the counter market, let's say you do not want a standardized contract, you want a customized contract, okay. So you will need to have the forward that you can get from the over the counter market, which can be risky because here the transaction is not happening through the exchanges, okay. So this is the basic idea. Now at present, all the transactions in OTC markets for rupee interest rate derivatives, for the forward contracts in government securities, for the foreign currency derivatives, foreign currency swap, foreign currency forward, foreign currency interest rate derivatives, the forwards, the swaps, and credit derivatives like credit default swap. So the swap and the forward contracts, the swap and the forward contracts, they happen over the counter market, okay. So the swap and the forward derivative contracts, they are the transactions that are happening in the over the counter market. Now they are currently reported. At present they are reported. It's not like that there is no reporting that is happening. Anyone can purchase any contract and such. So right now the reporting is happening to the trade repository that is managed by Clearing Corporation of India Limited, that is maintaining the report, that is maintaining the record, that is maintaining the information, the data and such, okay. So basically all the transactions in the OTC markets, all the derivative transactions in the OTC markets, that are the forward contracts or the swap contracts related to rupee interest rate derivatives, forward contracts in government securities, foreign currency forward contracts or foreign currency swap, foreign currency interest rate derivatives, and credit default swap like the credit derivatives, they are reported to the trade repository managed by the Clearing Corporation of India Limited, which is maintaining the record, which is maintaining the information, the data, okay. So this is the basic idea. I hope this is clear, that what is the derivative contract whose value depends upon the underlying asset, okay. The futures, forwards, swaps, options, they are the derivative contracts. The forwards and swaps, the forward and swap, they usually they are the transactions, derivative transaction that happen over the counter market, okay. Now we have understood about the derivative and over the counter market. Now coming to the UTI, I will take the extra queries at the end of the session, okay, how to write the notes, current affairs and all. So extra queries I will take at the end of the session. I hope the thing that I'm teaching right now is clear. I hope the thing is clear, okay. Now unique transaction identifier, coming to the UTI, okay, characteristics of UTI or the data related to UTI. So unique transaction identifier, first of all, it is a unique identifier. It is a unique identifier assigned to an OTC derivative transaction. That means the same transaction, let's say A and B party are doing a transaction, B or C and D party are doing a derivative transaction in over the counter market, so the different transactions that are happening will get different UTI, will get different unique transaction identifier. Now the Aadhaar card number that I have, is it possible that the same Aadhaar card number someone else can have? Legally it cannot be possible, right? So Aadhaar card numbers, they are unique. They are the unique numbers that are provided to different individuals living in the country. Similarly, the UTI, that is unique transaction identifier, is a unique identifier that is assigned to an OTC derivative transaction. So the transaction that is happening between A and B and the transaction that is happening between C and D will have different unique transaction identifiers. That is the idea. Now, unique transaction identifier is a unique identifier assigned to an OTC derivative transaction that shall be generated or reported for all transactions in OTC derivatives market undertaken in terms of the governing directions, that is governing the derivative transactions in the OTC market. So basically, all these transactions that we have discussed about, the rupee interest rate derivatives, forward contracts in government securities, foreign currency derivatives, foreign currency interest rate derivatives, and credit derivatives, these are governed by different directions. All these derivative transactions that are happening over the counter, these should have the unique transaction identifier, okay? So that is the idea. So unique transaction identifier is a unique identifier assigned to an OTC derivative transaction Now, how this will be generated, that we will understand. But first of all, what is this UTI? Okay, UTI shall be generated. First of all, UTI has to be generated in accordance with the UTI technical guidance issued by the Committee on Payments and Market Infrastructure. So this Committee on Payments and Market Infrastructure, this is hosted by the BIS, that is the Bank for International Settlement. That is the Bank for International Settlement. It provides a platform for the central banks around the world to cooperate, to come together and to cooperate in different areas. Okay, so the committee on payments and market infrastructure, this is a committee hosted by the Bank for International Settlement that provides a platform for the central banks to cooperate, for the central banks to have a discussion and such. So the CPMI, that is the committee hosted by BIS and IOSCO. It is the International Organization of Securities Commission. So securities market is under the security market regulator, like the SEBI in our country. So central bank in our country is the Reserve Bank of India, while the securities market regulator is the SEBI. So you can understand that the CPMI, that is hosted by the BIS, Bank for International Settlement, that is at the global level. It provides the platform for the central banks to cooperate in regards to reporting, in regards to the payments, clearing, settlement and such. While the IOSCO is the one, that is the international organization at the global level for the securities market, and it provides a platform for the securities market regulator to come together and to have the cooperation and discussion and such. So CPMI of the BIS and the IOSCO, the CPMI of the, that is hosted by the BIS and the IOSCO, they both together issued the UPI technical guidance. Okay, so UTI technical guidance, it was issued by the Committee on Payments and Market Infrastructure under the BIS and the IOSCO in February 2017. So you can understand that this UTI, it is not like that only RBI is bringing this UTI. Actually, this UTI, unique transaction identifier, it is at the global level, and it is for the different countries to adopt the unique transaction identifier for their OTC derivative transactions, so that the OTC transactions, the derivative transactions at the global level, there can be the transparency that can be maintained. Let's say that there is a Kavya of India is coming into a over-the-counter derivative transaction with John of USA. Now you can understand that this is the financial contract that has been signed in over-the-counter market. On the personal basis, this financial contract has been signed between Kavya and John. For, let's say, the Kavya is providing rupees and John is going to provide the dollars on some date, let's say 21st of March. So this is a forward contract, over-the-counter forward contract that has been signed. Now in India it will be reported, in USA also it will be reported. Now there is not much transparency because both the entities or both the counterparties are reporting it separately. So it can be seen as two different transactions, right? So UTI, what this UTI is going to do, that this financial contract, this over-the-counter financial contract, it will get a unique transaction identifier. So the same number will be reported in India, the same number will be reported in USA, so that it is clearly identified that okay, the transaction has happened between a person of India and abroad, USA. So this is the transparency that is provided through the UTI at the global level, so that the counterparty risk can be identified, and the countries where we have the transactions, or the countries that the people of our country are transacting with, can be identified easily at a global level. The data can be maintained. So this is the idea, that the UTI, it is very good in the sense that it is providing the unique transaction identifier, the unique identifier for the over-the-counter derivative transaction, not only at the country level but at the global level also. For a transaction, a single number will be released. Okay, so UTI shall be generated in accordance with the UTI technical guidance issued by the CPMI and IOSCO in February 2017, and at the global level it is easily recognizable, and at the global level a single number will be provided for a over-the-counter derivative transaction. So at the global level it can be easily identified. Now UTI shall have a maximum of 52 characters. Okay, UTI shall have a maximum of 52 characters comprising of the legal entity identifier. Now first of all, What is legal entity identifier? It is a 20-character alphanumeric code, alphabetic and numeric code used to uniquely identify parties to financial transaction worldwide. So LEI, it is the legal entity identifier that is provided to the entities, to identify the particular entities that are involved in a financial transaction at the global level. So UTI, you can understand UTI is to identify the over-the-counter derivative transaction that is happening at the global level, at the country level and the global level. Okay, so this number will help in identify over-the-counter derivative transaction at the country level and at the global level, as well as legal entity identifier. This is the identifier that helps in identifying the entities that are related or that are involved in the financial transactions at the global level. So legal entity identifier is a 20-character alphanumeric code used to uniquely identify the parties to financial transactions worldwide. So UTI shall have a maximum of 52 characters comprising the legal entity identifier of the entity that is generating the UTI for the over-the-counter derivative transaction, okay, and shall be unique. So this is the idea that the UTI will include the legal entity identifier of the entity that is creating the UTI. So that is generating the unique identifier that is generating the UTI and shall be unique to a derivative transaction throughout its lifetime. Okay, so the UTI will consist of the LEI plus other characters, and this UTI that is provided to a transaction should be unique for that transaction. Same number cannot be provided to some other transaction. That is the idea. So this is the idea. ISCO and CPMI, they work together to enhance coordination of standard and policy development and implementation regarding clearing, settlement and reporting. So CPMI and ISCO together, they issued the UTI technical guidance according to which the UTI will be generated in India, so that this number is the unique identifier that is provided to the OTC derivative transactions, so that at the country level and at the global level we have the clear identified OTC derivative transactions. We are easily able to maintain the transparency. Okay, and this UTI will consist of the LEI, that is legal entity identifier of the entity that is issuing the UTI plus the other characters. Now the UTI, responsibility to generate an UTI. So who has the responsibility to generate this UTI? Till now, any confusion, anyone? All clear? Is there any confusion anyone is getting? Now the UTI generating entity shall be determined as per the waterfall with the responsibility of UTI generation. So UTI generating entity shall be determined. Now who is generating the UTI? We have understood that, okay, all the over-the-counter derivative transactions, they should have a UTI. They should have a unique identifier. That means the number cannot be duplicated for some other transaction. So each transaction should have a unique identifier, and at the country level, at the global level, there should be a unique identifier for a OTC derivative transaction. Now who is going to generate this UTI? So UTI generating entity shall be determined as per the waterfall parameter, with the responsibility of the UTI generation assigned to the next entity in the waterfall. In case the first entity is not generating, is unable to generate the UTI or is unwilling to generate the UTI, that means the waterfall parameter will be followed. The first entity has the responsibility to generate the UTI. If the first entity is unable or unwilling to generate the UTI, then the second entity has to generate the UTI. That is the basic idea. So generation of UTI, these entities, the transactions reportable only in India. So if these transactions are happening between Kavya and Prameet, both are in India, and the contract, financial contract is being signed in India, it is happening in India. So this is the transaction reportable only in India because only Indian entities are involved. Okay, so in this case, who will generate the UTI for this financial contract that has happened over the counter? So for the over the counter derivative contract that is reportable only in India, the UTI will be generated by the central counterparty. Now central counterparty, let's say Kavya and Prameet, or the entity X and the entity Y, they are not trusting each other, and that's why they have a central counterparty. Central counterparty, it interposes itself. It is the intermediary that comes in between the two counterparties. That comes in between, that becomes the intermediary for the two counterparties, and it is the buyer for the seller and seller for the buyer. Okay, so it is the buyer for the seller and seller for the buyer. That is the idea. So central counterparty is the central counterparty. It is the intermediary. It interposes itself in between the two counterparties, and it maintains that the transaction happens. Okay, it becomes the buyer for the seller and seller for the buyer. So central counterparty, if it is involved, if a third intermediary party is involved, then it should release the UTI for the transaction. If the central counterparty is unwilling or unable to release the UTI, then the electronic trading platform. So let's say the transaction is happening through the electronic trading platform, then the electronic trading platform will be releasing the UTI. If the electronic trading platform is unable to release the UTI, in that case, out of the two entities, let's say the central counterparty is not present, the electronic trading platform is not present, Bank A and Bank B. These are the two banks that are doing the forward contract, the derivative contract among themselves in the over the counter market. That means privately the forward contract is being signed. So, and out of these two entities, they mutually decide that, okay, Bank A will release the UTI. Okay, so an entity as is mutually agreed between the two counterparties. So out of the two counterparties, if the central counterparty is not present, or if the electronic trading platform is not present, so out of the two parties, it can be decided that, okay, this particular party will release the UTI. I hope it is clear that there are certain forward contracts, there are certain swap contracts that are signed between the banks also, between the, let's say, Bank A and insurance company B. So amongst the counterparties, it can be decided that who will release the UTI. If they have also not released the UTI, if they are not also not releasing the UTI, then the last comes, that is CCIL trade repository, because they are the ones that are getting the report of the transactions that is happening in the over the counter for the derivatives. So the CCIL trade repository can release the UTI at last. Okay, so this is the idea. Now let's say transactions reportable in India and one or more foreign jurisdictions. Let's say that there is the transaction that is happening between Kavya and John, or between Bank A of India and Bank X of USA. So one party is Indian and the other party is foreign, okay, is foreigner. So in this case, the transaction is reportable in India because of course one party is of India. So the transaction is reportable in India, but the transaction is also reportable in foreign jurisdiction because the other party is of the foreign jurisdiction. Okay. So in this case, again, the first, if there is a central counterparty, if there is a central counterparty, that becomes the buyer for the seller, seller for the buyer, that is the intermediary that is looking after the transaction, that the transaction happens smoothly. So if the central counterparty is present, then this central counterparty should release the UTI, should release the unique transaction identifier for this OTC derivative transaction that is happening. The clearing member, if there is a clearing member is the one that helps in the clearing of the transaction and the settlement of the transaction. So if the clearing member is present, then the clearing member is the counterparty to the transaction, and that should release the UTI. Okay, so if the clearing member is present and it is a counterparty to the transaction, it is a part of the transaction, so then it should release the UTI. Let's say the electronic trading platform, this transaction is happening through the electronic trading platform. So if the first and second have not released, or they are unable or unwilling to generate the UTI, then the ETP has to generate the UTI. Let's say even the ETP is unable to generate the UTI, or there is no electronic trading platform, the transaction is happening on the private basis. Kavya and John, or let's say Bank A of India and Bank X of USA, they are having a private forward contract, over the counter derivative contract. Okay, so they are having this privately. So in this case, neither the UTI is generated by the CCP, because let's say CCP is not present, clearing member is not present, ETP is not present. In this case, if a foreign jurisdiction has a sooner reporting timeline, so if the foreign jurisdiction has a sooner reporting timeline in comparison to India, let's say in India, the transaction has to be reported within, like, on the trade day when the transaction happened, within 24 hours, let's say, okay, or within 48 hours. But in the foreign jurisdiction, the trade has to be reported on the trade day only, on the transaction day, within 2 hours. So that means the foreign jurisdiction has a sooner reporting timeline. If the foreign jurisdiction has a sooner reporting timeline and the UTI is not generated by the previous entities, then in this case, the entity as per the requirement in the foreign jurisdiction. That means the foreign jurisdiction entity or the entity decided by the requirements in the foreign jurisdiction, that entity will release the UTI, will issue the UTI. And as you know that a UTI should be one only, a unique identifier number for the transaction at the global level also. Okay, so that means if the foreign entity is releasing the UTI, Indian entity cannot separately release the UTI. The Indian entity has to take the UTI from the foreign entity. I hope this is clear, because there can be only one number for one transaction. So for this transaction, if a foreign entity is releasing the UTI, then the Indian entity has to take the UTI from the foreign entity. So an entity as per the requirement in the foreign jurisdiction will release the UTI. Let's say if the foreign jurisdiction does not have sooner reporting timeline, then the entity that is mutually decided between the counterparties that will release the UTI, or the CCIL, a trade repository, will release the UTI. So that is the idea. So in terms of the waterfall, if the transaction is reported to the Clearing Corporation of India Limited trade repository without the UTI, so if no other entity is releasing the UTI, so last responsibility is of the CCIL trade repository. It will have to generate the UTI for the transaction. I hope this is clear. Chalo, any confusion, anyone? So this is the idea. So basically, transactions that is reportable in India as well as in the foreign jurisdiction, these entities will have to release the UTI. But if they are unable or unwilling, or if they are not present, if the transaction is not happening through the electronic trading platform, if the transaction is not happening through the CCP or the clearing member, and the Bank A of India and the Bank X of USA, they are coming together on the personal basis, on the private basis, and they are doing the transaction. If a foreign jurisdiction has a sooner reporting timeline, then the foreign entity, as per the requirement in the foreign jurisdiction, so the foreign entity will release the UTI, and this number has to be obtained, or this number has to be taken by the Indian bank also, to provide this number to the CCIL, or to provide this number for the transaction in India, for the reporting in India. Okay, because only one number, even if it is generated by the foreign entity, only one number at the global level, at the country level, only one number can be reported for a transaction. So if a transaction is happening between Indian entity and foreign entity, only one number will be generated, either by the Indian entity or by the foreign entity. If the foreign entity is generating that number, that has to be reported in India also by the Indian entity. Okay, so this is the idea. Now let's say if a foreign jurisdiction has a sooner reporting timeline and the foreign entity, as per the requirement in the foreign jurisdiction, is releasing the UTI. So for transactions that are reportable in India, as well as these transactions are reportable in foreign jurisdiction, and the foreign jurisdiction has a sooner reporting timeline, market participants in India may undertake reasonable efforts to ensure that the UTI that is generated by the foreign entity is obtained by the Indian market participant, by the Indian counterparty, to report it in India. Because this one number that has been released has to be reported in India also. This is the unique number that has to be reported for that transaction, for that particular transaction. So market participants, that is the counterparty, may undertake reasonable efforts to ensure that the UTI is obtained and reported within the reporting deadline in India for the transaction. But let's say in case the market participant is unable to obtain the UTI within the reporting deadline. Reporting deadline in India for the transaction is, let's say, the transaction plus 24 hours. The transaction day, so one extra day, T plus 1 basically. So one extra day is given for the reporting. So reporting deadline has been met, but still the Indian entity is not able to get the UTI from the foreign entity. So Indian entity, if it has not been able to get the UTI from the foreign entity, that means it will not be able to report this UTI. In this case, a temporary UTI can be created for reporting the transaction in India. But it has been said that, however, in whatever means, the Indian entity will have to take the final UTI from the foreign entity. The UTI has to be taken within 5 Mumbai business days. That is the idea. So in case the market participant, the counterparty or the market participant is unable to obtain the UTI from the foreign entity for the transaction that has happened with the foreign entity within the reporting deadline, in this case, there is a temporary UTI that can be reported by the market participant or generated by the CCIL trade repository, so that at least initially the reporting can happen of the transaction. But the market participant should obtain and submit the final UTI, to the CCIL trade repository at the earliest within 5 Mumbai business days from the date of the transaction. So that is the idea. Okay. So the temporary UTI will be later on when the final UTI has been achieved, then this temporary UTI will become the interim UTI. So what is the process? Basically, let's say foreign entity is generating the UTI for the transaction that has happened between Bank A of India and the Bank X of USA. Because the reporting is sooner in the foreign territory, that's why the foreign entity as per the requirement of the foreign jurisdiction, the UTI will be released. Now, the Bank A of India has to obtain this final UTI, because only one UTI will be released, only one number has to be reported. So this has to be obtained. Basically, Bank A has to take the UTI from the foreign entity, but let's say the Bank A is not able to obtain it on a sooner manner, and the reporting has to happen within the next day. Within 24 hours, the reporting has to happen. So a temporary UTI will be generated by the Indian entity or by the CCIL trade repository, where the reporting of the transaction is happening in India. Now, this temporary UTI is only temporary. It is not final. Okay. So this temporary UTI is only temporary. The Bank A is mandated. Now, Bank A is mandated that as soon as possible, the UTI has to be obtained from the foreign entity, but not more than within 5 business days. 5 Mumbai business days. So within 5 Mumbai business days, the UTI has to be obtained in any manner. You have passed the reporting timeline, it is fine. But within 5 Mumbai business days, obtain this UTI in any manner, and this UTI then will be reported as the final UTI. And this temporary UTI will become the interim UTI. So I hope this is clear. So this is the idea that for transactions that are reportable in India, and in foreign jurisdiction, but the foreign jurisdiction has a sooner reporting timeline, so an entity as per the requirement in the foreign jurisdiction will release the UTI. Market participants have to make all possible efforts to obtain this UTI within the reporting deadline, that might be, let's say, transaction plus 24 hours. That is T plus 1 day. So within the next day, the UTI has to be reported to the CCIL trade repository. But let's say that market participant is unable to obtain this UTI, this final UTI, within the reporting deadline of T plus 1 day. So in this case, a temporary UTI will be reported by the market participant or generated by the CCIL for the initial reporting of the transaction. In India, so that at least initial transaction reporting is happening. But it is said that the final UTI has to be obtained within 5 Mumbai business days from the date of the transaction. So within 5 Mumbai business days, the UTI has to be submitted. The final UTI has to be submitted, and then this temporary UTI will become the interim UTI, and this final UTI will be the UTI at the Indian level also, at the global level also. Now, coming to the last points. So amendment to a derivative contract. If there is any change that is happening on the derivative contract, let's say the date has been pushed forward, or the number of the shares, or the let's say the foreign currency that had to be traded, let's say $1,000, it has been made $1,500 or $1,200 and such. So any amendment to a derivative contract after reporting to the CCIL trade repository shall not necessitate the generation of a new UTI. So there is no need to generate a new UTI. Okay. However, a life cycle event means that a novation has happened. Before, the contract was between party A and party B. Now the party B is leaving the contract and the party C is taking over the contract. That means party B is saying that I cannot continue with this contract, but I have a replacement, that is party C. So party is fine, party A is fine with this, that okay, party C can take over. So now a new contract, a novated contract will be signed between party A and party C. Now this will have a different UTI. So I hope this is clear that if there is any amendment to that is happening, if there is any amendment to a derivative contract after reporting the contract to the CCIL trade repository, this shall not necessitate any new UTI. Okay, no need to have a new UTI because there is a minor change that happened in the contract. But if a life cycle event is happening, such as novation, where the party to the contract is changing, in this case, there is a new reportable derivative contract and new UTI that should be generated, because now this is a new contract, completely new contract between the different party. So a new UTI should be created. That is the basic idea. So coming to the last slide, that is the Reserve Bank of India has now decided to maintain UTI. So the UTI has been mandated, the unique transaction identifier has been mandated for all these specific derivative transactions that happen at the over-the-counter market. Okay, it applies to now this UTI, unique transaction identifier, applies to the OTC derivative transactions entered into on or after January 1, 2027. So basically the OTC derivative transactions that will be entered into or after this date, so from January 1, 2027, all the OTC derivative contracts should have the UTI, that will be recognizable. The same number will be recognizable at the Indian level as well as at the global level. CCIL has been made responsible to issue operating guidelines and broader guidelines and reporting formats for UTI reporting, because CCIL Trade Repository is the one that gets the report of the OTC derivative transactions. It get the reporting, it get the data for the OTC derivative transaction, so it should also receive the UTI. Okay, it should also get the reporting of the UTI. That is the idea. Chalo, any confusion, anyone? Now this is the first question. I hope you will be easily able to answer the question. The UTI for OTC derivative transactions is required to be generated in accordance with the technical guidance issued in February 2017 by which of the following bodies? Okay. So this is the first question. Now the second question is regarding the UTI. You have to tell that which of the following statements is or are correct in regards to the UTI. So if you have understood about the UTI, if you have the basic idea about the UTI, you will be able to answer this kind of question. Now these are the two questions, or these are the kind of questions that can come in the examination from the UTI. Okay, that is a unique transaction identifier, like you have your Aadhaar card number to identify yourself as a member of the country, as a citizen of the country. UTI is the unique transaction identifier to identify the over-the-counter derivative transactions. Okay, over-the-counter derivative transactions that are happening between the Indian parties or between Indian and the foreign party. So this is the idea, and there will be the unique transaction identifier for the over-the-counter derivative transaction. So this is it. So this is it. Thank you everyone. I hope you enjoyed the session. I hope you understood the basic idea of the UTI and the requirement of UTI for the derivative transactions that are happening over the counter. So this is it. Thank you everyone. Thank you for joining.